Alright, let's run through some journal entries that are common for retail transactions. Our first one is purchasing inventory with credit terms. So on March 1st, Footstep Footwear, that's us, purchased 100 pairs of basketball shoes for $80 per unit on account from eBay, who's our vendor. The terms of this purchase are $215 net 30. Means we get 2% off if we pay within 15 days and the entire balance is due within 30 days. How do we record this entry? Well, what accounts are being affected? The first thing that we're buying is merchandise inventory. It's, these shoes are something we're going to have that we intend to sell later, but we haven't sold them yet, so we can't record the expense for the purchase. We have to let them sit on our books in our inventory until we actually sell them. That's what we're buying. How are we paying for it? We're paying on account. So the second account is accounts payable, and we're going to use a subsidiary account for this specific vendor, so let's call it AP eBay. What type of accounts are they? Well, inventory is always an asset, and payable means liability. Are the accounts increasing or decreasing? Well, the amount of inventory we have is going to go up after this purchase. The amount of money we owe to eBay is also going to go up. So what side do these accounts increase or decrease on? Assets go up on the debit side, liabilities go up on the credit side. So we know our entry is a debit to merchandise inventory and a credit to AP eBay. So on March 1st, we start by debiting merchandise inventory for how much? We're going to use the conservatism principle, which means we assume that whenever we buy merchandise inventory, it's going to cost us as much as it possibly can. We are buying 100 pairs of shoes, and those shoes are at $80 a unit. Sure, eBay is offering us credit terms. We could get a 2% discount, but because we're being conservative, we're going to assume that we're not going to get that discount. We're going to end up paying full face price for these shoes, which would be $8,000. So we debit merchandise inventory for $8,000. We credit AP eBay for that same $8,000. For the description, what I do is I denote what we purchased, how many units of it we purchased, at what price we paid per unit, and as well as the terms. And I do this because it makes it easier to go back and look through your journal to find the terms of your purchase than it is to go back and look through all of your invoices and all of the billing statements. You don't have to. You could just write purchased inventory, but I like to have a little more detail, so that's how I write my description for retail transactions. On March 1st, we purchase the inventory. Now let's assume that we're going to pay for it on March 10th. So on March 10th, first step is going to pay eBay in full for this March 1st purchase. The terms again of the purchase were $215 net 30. The terms state we get 2% off if we pay within 15 days. We bought it on March 1st. It is now March 10th. That's only 9 days. So we are paying within this discount period. We're going to get that 2% discount. The problem with that is we assumed that we weren't when we put the entry on the books. So this is actually going to affect 3 accounts. The first is going to be our payable. We are paying off eBay, which means we need to take that liability off of our books. The second account being affected is our inventory account. Why? Because we have to keep inventory on our books at the cost that we paid for it. Well, when we made this purchase, we assumed we weren't going to get the discount, and we put that inventory on the books at the full possible cost it could have been, which was $8,000. But now we are getting the discount, which means we put too much cost in the inventory at the time that we recorded that purchase. We need to decrease it now to bring the merchandise inventory from this transaction down to what we actually paid for it. And then lastly, we have cash because we're paying off this debt. So our cash has to be going out of our business to our vendor, eBay. What types of accounts? Payable means liability. Both inventory and cash are assets. Are they increasing or decreasing? Well, we're paying off our debt, so that liability has to be going down. We're decreasing the amount of our merchandise inventory because we didn't pay as much for it as we planned on when we made the original entry for the purchase. And our cash is also going down because we're transferring money out of our bank account to our vendor. Liabilities go down with a debit, and assets go down with a credit. So we know what our debits and our credits are for this transaction. So on March 10th, we start with a debit to AP eBay. We put this on the books on March 1st for $8,000. We're not sending them $8,000 now because we're getting a discount, but we need to take that liability in full off the books so our books look like we don't owe East Bay any money, because we're not going to after this transaction. Our first credit is to merchandise inventory, and that's the amount of the discount we're going to receive. Well, what's our discount? $8,000 was the full face value of this purchase, but we're getting 2% off. So 2% of 8,000 is $160. We're getting $160 off, which means we have to decrease our inventory account by that same $160 to, recognize the fact that we didn't actually end up paying that for the inventory, which means since it was $8,000, but we get $160 off for paying early, we only have to transfer $7,840 in cash to East Bay when we pay them within this discount period. Let's look at the same transactions but a different scenario. Now let's assume we're not going to pay East Bay until March 17th for that March 1st purchase. Well, the terms were $215, which means we had 15 days to pay them. It went from March 1st to March 17th, which means it's been 16 days. We missed our discount period. That's okay, because that's what we assumed was going to happen when we recorded the purchase in the first place. So what accounts are going to be affected? Our liability account, our accounts payable to East Bay, and our cash account. They are a liability account and an asset. Our liability is going down, our cash is going to go down, and liabilities go down with a debit, assets go down with a credit. The entry that we have right here is the same entry you always have to pay off a liability. We assume we were going to have to pay the full $8,000. We missed our discount period. We do have to pay the full $8,000. So we had the liability on our books for exactly what we ended up paying, which means all you have to do to take it off your books is debit your liability account and credit your cash account when you pay your vendor. Next up, we have the sale of inventory with credit terms. So on March 1st, First Step Footwear, which is still us, is going to sell 12 pairs of sneakers for $120 a piece to the basketball team at St. James High School. We're going to offer St. James terms of 5, 10, net 60. So they get 5% off if they pay within 10 days. Full amount is owed to us within 60 days. First Step paid $80 for these sneakers, and that's how it works for a retailer. We paid $80 for these, but we're reselling them for $120 because that markup is how we make our money. So what accounts are going to be affected? Well, a lot of them, because when you're a retailer, every time you make a sale, you actually have to record 2 entries. You have to record 1 entry to recognize the revenues. You recognize revenues as soon as you actually make the sale and give up custody of the inventory that you're selling. You also need another entry to recognize the expense, to move those goods out of your inventory and record them as a cost of goods sold expense. Let's start with the revenue entry. In the revenue entry, the 2 accounts that are going to be affected are what you're doing to make money and how you're being paid. This is an on-account transaction because there are credit terms. So the first one's going to be a receivable account. Again, we'll use a subsidiary. It's AR St. James. The other account is our sales revenue account. Our receivables account, all receivables are assets, all revenue accounts are revenues. Are they increasing or decreasing? Well, the amount of money that St. James owes to us is going up, so we need to increase that AR account. The amount of revenue, the amount of sales that we've done during the period, is now also going up because we just made another transaction. And all assets go up with a debit and all revenues go up with a credit, so we know what our entry is going to be. On March 1st, we debit accounts receivable from St. James. How much do we debit it for? Well, we're being conservative, which means we're going to predict that St. James is going to pay us as little as possible. How do they do that? By paying within the discount period. We offer them 5% off if they pay within 10 days. Let's assume that's going to happen, which means we're not going to get the full face that we're billing them for. What are we going to get? Well, if we take the number of sneakers that we're selling them, which is 12, and multiply it by $120, we would get the full amount that they could pay. But we're assuming they're going to get a 5% discount, which means they're only going to give us 95% of that. And if we take 12 times 120 and multiply it by 0.95, we get 1,368. So we are assuming in this case that St. James High School is going to take their 5% discount and only have to transfer to us $1,368. That is the amount of revenue we're going to record at the time of sale. Again, I typically denote how many units we're selling, what the cost is per unit, and the terms of the transaction at the time that I make the sale. That's the first part of a set of sales entries. The second part is to record the expenses. So when we record the expense from this transaction, expense for a retailer is a dead giveaway that you have to use your cost of goods sold account. What's the other account being affected? You no longer have, in this case, those sneakers. We're selling them to someone else, which means we don't have them sitting around waiting to be sold and converted to revenue, which means we need to reduce the amount of inventory that we have on our books because we no longer have possession of those sneakers. Cost of goods sold is an expense, inventory is an asset. The amount of expense that we are going to be recognizing for sales that we made during the period is going to go up because we just sold another item, so our cost of goods sold has to go up, and our inventory has to go down because it's no longer sitting in our storefront. It's in the hands of St. James High School. The expense account going up means we have to debit it, and assets come down with a credit. So on March 1st, we're going to start by debiting cost of goods sold. The expense, whenever you record a sale, is for the value you have on the books that you paid for it. Not what you're selling it for, but what your original cost was to purchase it. St. James, first step, when we bought these shoes, well, we bought these 12 pairs of shoes at $80 a piece, which means that's a total of $960. That's the amount of expense we're going to record when we make this transaction. Also going to reduce our inventory account by that same amount when we record the cost of goods on this sale. Later on, we're going to receive payment from St. James for this transaction. So on March 10th, if we receive payment from St. James, we first check to see if they're paying within the discount period. March 1st to March 10th is 9 days. We offer them 5% off if they paid within 10 days. Well, 9 days is less than 10 days, so they are getting their discount, which is fine because that is what we assumed when we put it on the books in the first place. So, to record the receipt of cash, we got to use our cash account, and we also have to change our books to denote that St. James High School no longer owes us money. So the second account being used is going to be our accounts receivable account. They are both asset accounts. The amount of cash we have is going to go up because we're getting paid. The amount of receivables that we have from St. James, the amount of money that our books say they owe us, has to be going down because they're paying off this debt to us. And assets go up with a debit and down with a credit. So when we make this transaction, it's as simple as can be. We assumed they were going to pay within the discount period. They are paying within the discount period, which means the amount of money they owe us is exactly the same as the receivable we put on the books, which was $1,368. So our journal entry for when we receive payment from St. James High School is just a debit to cash and a credit to their AR account for the amount that we assumed they were going to send us at the time that we made the sale. But what happens if they miss their discount period? Let's say they don't pay us until March 17th. Well, in this case, we got something else going on here. We told them they'd get 5% off if they paid within 10 days. We made this transaction on March 1st. It's now March 17th. That's 16 days. They missed their discount window. So what do we do? Well, we're still going to be getting cash. They are paying us. And we still need to take their receivable off the books because they're paying off their debt. Problem is they're going to have to pay us more than we put the receivable on the books for because they missed their discount period, and we assumed that we were going to get that discount. They forfeited their discount, if you will. And when that happens, you have to use an account called sales discounts forfeited. Cash and AR are assets. Sales discounts forfeited is a revenue account. It's just a variation on sales revenue. Are they increasing or decreasing? Well, we're getting the cash, so that's going up. They're paying off their debt to us, so their receivable is going down. Sales discounts forfeited tracks how much discount our customers gave up by not paying within the discount period. Well, now there's even more discounts that were forfeited during the period, so this has to be going up as well. Assets go up with a debit and down with a credit, and revenues go up with a credit. So on March 17th over here, we're going to debit cash for $1,440. Where did I get that from? We sold them 12 pairs of shoes at a face value of $120 a piece. 12 times 120 is $1,440. The receivable, however, was put on the books for $1,368, and we can't take it off the books for more than it was on for. So we credit the receivable for whatever amount we put it on the books for in the first place. We also have to credit sales discount forfeited for the difference between the two numbers, which is going to be $72. And we receive payment from St. James.